Hello everyone. Today's video is going to be on investing, and I hear a lot of positivity usually when people talk about investing their money, right? You hear about how you can get wealthy through real estate, you can get wealthy through stock markets, you can get wealthy through insert all these different means, right? What I want to remind everyone today is that investing oftentimes is the long man's game. And what I mean by that is it's not designed to make you a lot of money overnight, right? There are times where stocks do tremendously well. And an example I will give you is there was a stock I invested in as far as an IPO earlier this week. And 24 hours after the IPO, the stock was up 839%, right? A lot of money. I didn't cash out because I didn't have an opportunity to do anything with it. And another 24 hours later, it was back to like just a couple dollars over what the original share price was, right? I missed out on a variable cash cow. Now, had I been one of those people who purchased the stock as it was climbing, I would have lost a lot of money, right? Like I would have lost a substantial amount of money on that stock. Fortunately, though, because I got it on the ground floor at $4 a share, it wasn't as heartbreaking, right? So the purpose of this video is to kind of help everyone understand stock markets have ups and downs. Investing has ups and downs, right? You have to be able to plan for the downs while you're in the ups. And one of the key things to remember, and I'm going to use Amazon as the example on this, right? Amazon shares have been tanking lately, right? But they're getting ready to do a 20-to-1 split. And you also have the fact that they just won, I think it's like a $10 billion cloud contract, which will be disputed and, but most likely will still be awarded to them. That if you buy those shares when they're down, if you pick up those investments while they're low, and then hold on to them for the long haul, you make pretty decent money. And one of the things you don't usually hear people talk about too much is dividends, right? Dividends are a great way of making money. So when you invest in index funds, when you invest in mutual funds, typically speaking, you do not get dividends, right? But when you purchase the shares outright, not fractional shares, but the whole shares, you do get dividends, right? And right now I am averaging on one of my portfolios, I'm averaging around $80 a month in just dividends, which is amazing. It's a wonderful feeling to be making $80 just for it sitting there. Even if the stocks go down in value, like the stock market has been really rough over the past couple of months. Guess what? I still get that $80. That for every share that I have accumulated in this portfolio, which I think I have positions in, it's like 236 different companies in this portfolio. And I really can't complain. I consistently get at least $80 a month just from it sitting there, right? And that's just in dividends. That doesn't count the interest that I get for stock lending. That doesn't count positive fees where I'm reimbursed money. What I'm trying to say is there are a lot of different ways to get additional money. One of the biggest bits of advice I give is do not look at the stock portfolio every day, right? Like I opened up mine for a little bit yesterday to buy another share of Amazon while it's down. And when I looked at it, ouch, right? Like, ouch. It was negative $10,000 right now, right? Bright side, and this is how you steal your mind and don't let yourself freak out. Did you need the money right now? Did you need to sell right now? Right? For things that you need as more of an emergency fund, try to keep investments put in like a high yield savings account, or try to keep them in like a money marketing savings account. Try to do something of that nature, right? Because if you need liquidity, you don't want to have, and liquidity being I can sell really quick and get my money back, right? You don't want to have positions tied up in things that are difficult to sell or that you would be selling at a substantial loss, right? The other thing to remember, especially as you grow your portfolios, right, is when you incur a loss, sometimes it's strategic. I have claimed losses for strategic purposes to offset income earned that year, right? Because it's a loss that I know is not going to get any better. I know that company is not going to come back up to where it was beforehand because there's been certain things that have happened. And I feel fairly confident enough to go ahead and offload at a loss, right? The next thing I'm going to talk about is real estate. Real estate is absolutely beneficial, right? It's absolutely good to have. The challenge that you run into with real estate, and the one that was a painful lesson for me, property tax. Property tax, you would think this is something that you can kind of expect and plan for and everything else, but let's go ahead and talk about the housing bubble real quick. One of my properties went up more than, it was like 65, almost 65% in net worth over a couple of months. And the county that property is sitting in, the county decided to reassess property taxes while the market is bubbling, and hit me with the increased taxes for that property, which were heavy, like heavy, right? And it just made me, kind of grimace, right? So when you're trying to do investment properties, you have to consider the fact that your property taxes can always go up or go down. Additionally, you have the reality that you will be responsible for fixing some pretty big ticket items sometimes. For instance, I have one of my properties that has the air conditioner in it's from 1994. Okay, this air conditioner, I am surprised hasn't gone out yet. I am really like, a solid air conditioner, right? But the reality is that's gonna die soon. That air conditioning unit is gonna die soon, and I'm gonna be looking at around $10,000 to replace it. So I have to make sure that anything that I'm making on that is being stashed aside and that I can replace it when it does go down, because otherwise, that would be a pretty scary moment, because you can't have a tenant renting your property and not provide that type of, brain is not cooperating for me, and I apologize for that. It's a requirement that you have to provide AC in the state that I'm in, right? So you definitely have to have that. So the last investment that I want to talk about is crypto, because crypto is kind of something that a lot of people have been on the bandwagon, off the bandwagon, and they feel that there's a lot of very polarizing opinions on crypto, right? So here is my opinion on crypto. Crypto is a aggressive investment strategy in my eyes, right? And I say aggressive because there's the opportunity, one tweet. You think about what happened with Dogecoin when Elon Musk is like, yeah, Doge, and what happened with Shiba Inu when it came out, and it just went boom and exploded to more than 1,000% of its initial worth, right? In both of those instances, I made quite a bit of money, right? The reality, though, is one tweet. That's all it takes. One country deciding to regulate is all it takes. One tax change is all it takes. And you can have your entire wallet blocked off from you. So any investment that you do within crypto, you need to be prepared. You need to be prepared to lose that money, right? Because this is an aggressive investment, aggressive meaning that you have the likelihood for huge gains, but you also have the likelihood for significant losses as well. So never invest anything that you absolutely need to have into crypto. Same thing can kind of be said with stocks, right? Depending on the types of stocks that you're purchasing and the volatility of that particular market, the volatility of that particular corporation. Sometimes it could be something as simple as a blue chip stock, which would be like Walmart, right? Walmart's usually pretty consistent. Walmart almost always has the same shares. They progressively get a little bit further up there. There are other ones that are a little bit less reliable, right? I invested in Sundial, and Sundial had some pretty substantial changes, and that stock value went plummeted, right? And I still hold all my shares because they still pay dividends every now and then. But just remember, investing, try to diversify what you have. And when I say diversify, I mean diversify holdings, not just everything stock market. Key thing here, when people talk about diversifying a portfolio, they don't just mean your stocks. They don't just mean your crypto. What they mean is having multiple different assets that are making money for you on a monthly basis. Remember that corporate real estate, right? So when you start talking about business space, is really viable and doesn't have all the same limitations that residential real estate have with it, right? Remember that crypto is volatile. It's very high risk, okay? So the purpose of this video is just to kind of give a few little ideas. I am by no means the expert on this stuff, and I would advise you listen to channels like, what is it? Ask Graham, I think it is, or Ask Steph. Stephen Graham, he's on YouTube. He's pretty savvy, pretty animated, a lot more energetic than what I am, right? But you can get some pretty good ideas for real estate investments and for stocks through him. Pay attention to the market, read the prospectus for various businesses and all that before you invest in them. Take the time, right? And always remember, high yield savings accounts and money marketing savings accounts are great tools when you need this money to be stable. Like, I don't think I'm going to need to touch it, but this is my emergency fund, and I don't want it to be sitting in a lower yield savings account or a lower yield checking account, right? You move it into the HYSA or the MMSA and enjoy a little bit of additional interest as that security vehicle sits there. So aside from that, I hope everyone has a wonderful day. Thank you for watching, and I hope this helps you in some way.